Good morning. This is Barry Knapp with, pardon me, Ironsides Macroeconomics. It's Monday morning, December 16th at 7:30 Mountain Time. This is a complimentary version of our weekly video summary of our weekly note. The note this week was titled "The Trump Treasuries Trade." It was a typical or standard weekly note. We took a little bit of a break from our annual outlook process. We'd written our 2025 outlook note a week ago, talked about that with clients in New York and Boston last week. And in the note this week, we're providing some of those observations. This week, we'll publish our annual thematic note, 4 or 5 themes we expect to persist through the business cycle, and then we'll do our year in review note the week of Christmas. So to begin with, clients on balance were skeptical of the Republicans' ability to make the Tax Cuts and Jobs Act provisions permanent and cut spending to anywhere near 20% of GDP. Implicit in that, or as a consequence of that skepticism, we saw a pretty good bear steepening of the Treasury curve last week, led by higher real rates, swap spreads moving back to their lows for the 10-year and 30-year tenor, which is an indicator of supply. We had a pretty good 3-year auction, a good 10-year auction, and then a very sloppy 30-year auction. The 30-year is the asset most sensitive to supply. And we think it was very consistent with what we heard from clients last week who really do not believe that the Trump team will be able to significantly impact the trajectory of government spending and government debt. Most clients were expecting a correction to begin, perhaps as soon as Inauguration Day. So on balance, there was a lot of New York City, Wall Street cynicism of what was going to happen in DC. None of that should be surprising, but that is probably the single biggest risk to markets right now, is that rates have another one of these bear steepening supply-driven sell-offs. So moving on through the data and our analysis of that, last week's inflation data showed goods prices starting to firm up. That's been the major source, along with energy, of disinflation or deflation actually in goods prices. But those are firming. Now, we don't expect goods prices to continue to firm. We've had a 5% rally in the trade-weighted dollar since September, so that should take any of the heat off of goods prices. But nonetheless, that was where we saw some upward pressure in inflation. From the Fed's perspective, they're going to view the cooling of rent of shelter down to a 0.3 from a 0.39 the previous month, and a series of hotter than that prints throughout the course of the last few years. They're expecting rents to cool. So when they look at the inflation numbers last week, I think they're going to be more comforted than the narrative we heard on television. The most underappreciated economic story right now is that demand for labor is weak. The chart I'm showing in this video is from the Atlanta Fed Wage Tracker. It's a number that falls a little bit under the radar, but it shows demand, particularly for low-end workers, is really cooling. The paid hourly series dropped from 4.3% to 4% in November, and that is a 3-month average. So you can only imagine how weak the November reading was. We've been talking about the weakness in the household survey, the rise in the unemployment rate, as being a much cleaner indicator than the monthly payroll numbers for the better part of a year. And that drop in wages, the proof is in the pudding, and the pudding is wages, and wages are cooling here in this series that does a very good job of correcting for mix shifts and the like. So we actually think that this is the most underappreciated story, and is the reason why, yes, the Fed should be cutting this week. Yes, they should cut in January, and yes, they should continue to cut to, say, 3.25% in 2025. That's not likely to be their forecast. They'll probably show inflation a little hotter, probably at least 1 fewer rate cuts in their forecast than they expected back in September. But we think ultimately, because of this weakness in the labor market, which will become apparent over the course of a few months, that the Fed will wind up cutting persistently down to about 3.25% or so. So that's it on balance for the economic data. As I said, the biggest risk to the markets right now is not that this labor data holds the Treasury market in place. It's that people start pushing on this idea that the supply of Treasuries is going to overwhelm the demand and rates are going to push higher, and that the Trump team will not be successful in incoming Treasury Secretary Bessent's first arrow, which is a 3% budget deficit. That's it for me this week. Again, this is a great time of year for you all to consider becoming a full subscriber. You're getting institutional quality research at a very approachable price for sophisticated individual investors, wealth advisors, and so on. Barry Knapp from Ironsides. Have a good week, everyone. Thank you.